Every year, millions of Americans go through the same ritual of dread. They gather their documents, stare at confusing forms, and calculate how much of their hard-earned money is about to be sent to the government. For people living in some of the most expensive states, that feeling is even more intense. It often feels like you're being punished just for living where you do. But what if a quiet change, buried deep inside a massive new bill, was about to flip that script? What if a rule that has cost you thousands of dollars a year was suddenly wiped away? This isn't a fantasy. A new law has just been signed, and it's about to trigger a financial shockwave that will put a staggering amount of money back into the pockets of middle-class families. This is the story of a hated tax, a stunning political reversal, and a temporary window of opportunity that you need to know about. The bombshell announcement dropped with surprisingly little fanfare, but its implications are enormous. A new law has officially quadrupled the cap on the state and local tax deduction, better known as SALT. For the last several years, taxpayers have been shackled by a painfully restrictive $10,000 limit on this deduction. To truly grasp why this is a seismic shift, you have to understand the enemy it's replacing. The $10,000 SALT cap was one of the most controversial and deeply unpopular tax provisions in modern history. Before 2018, the system was simple. You could deduct the entire amount of your state and local taxes from your federal taxable income. It was a long-standing principle of American tax law, but the 2017 reform put an abrupt and brutal end to that. Imagine you earned $100,000 and you paid $15,000 in state income and property taxes. Logically, you should only pay federal taxes on the $85,000 you actually got to keep. But the SALT cap created a system of double taxation. Under that rule, you could only deduct $10,000 of the taxes you paid. This meant the federal government was taxing you on $5,000 of income that you never even saw it had already gone to your state and local government. For families in high-tax states like California, New Jersey, and New York, this wasn't a minor annoyance. It was a financial body blow that cost them thousands of dollars year after year. So, who are the biggest winners in this story? The answer is clear: homeowners in California's notoriously expensive cities. For years, they've been trapped in a tax vice, crushed by property tax bills that made the $10,000 cap feel like a joke. Let's look at the numbers. In San Jose, a staggering 47.9% of all homeowners pay more than $10,000 a year in property taxes. In San Francisco, that number is 40.9%. Let's make this real. A hypothetical family in a San Jose suburb with a modest home might pay $18,000 in property taxes, and another $12,000 in state income tax, for a total of $30,000 in state and local taxes. However, it's crucial to understand that this isn't a blank check from the government. There is significant fine print, and the two biggest catches are an income limit and a strict expiration date. This new $40,000 cap is not available to everyone. It is specifically targeted at taxpayers with an annual income of $500,000 or less. This detail is a political masterstroke designed to frame the tax cut as relief for the middle and upper middle class, shielding it from criticism that it's just another giveaway to the ultra-wealthy. The second, and perhaps more important, catch is that this relief is temporary. The new law is only effective for the tax years 2025 through 2029. After that, on January 1, 2030, the cap is scheduled to automatically revert to the old $10,000 limit. The law even includes a tiny 1% annual increase to both the cap and the income threshold to account for inflation. Meaning by 2029, a household earning up to $520,000 could deduct over $41,600. This creates a 5-year golden window of tax relief, but it also puts a firm, non-negotiable deadline on it. Beyond the immediate tax savings for current homeowners, this change is poised to send major ripple effects throughout the hyper-competitive housing market. It could fundamentally alter the landscape for first-time buyers. For years, ordinary families have been forced to compete against large-scale corporate investors who swoop in and buy up homes. Those investors have always had a massive, unfair advantage. Because their properties are treated as a business, they were never subject to the SALT cap. They could always deduct the full cost of their property taxes, mortgage interest, and maintenance as business expenses. This new law helps to finally level that playing field. Danielle Hale, the chief economist at Realtor.com, noted that this change puts individual buyers on somewhat equal footing with investors. Imagine a young family that was previously intimidated by a home with a $17,000 annual property tax bill. Before, that was a huge liability. Now, knowing they can deduct that entire amount, it becomes a manageable expense. This could be the confidence boost needed to bring more individual buyers back into the market, giving them a fighting chance against the faceless corporations. And in a final, crucial twist, this story isn't just about homeowners. You might be a renter in California thinking this has nothing to do with you, but you could be wrong. The SALT deduction is a combined limit that covers more than just property taxes. Taxpayers have a choice. They can deduct their property taxes plus either their state income taxes or their state sales taxes. For a state like California, which has the highest state income tax rate in the entire country, this is a huge deal. A hiring renter in Los Angeles or San Francisco could easily pay over $20,000 in state income taxes alone. Under the old rule, they lost out on a massive deduction. Now, they too can claim that full amount. This makes the new law surprisingly relevant to a much broader swath of the population, providing a small but welcome relief from the constant financial pressure of living in a high-cost state. It's a detail that many will miss, but one that could save them thousands. So, where does this leave us? For the next 5 years, millions of families in California and other high-tax states are set to receive a substantial, though temporary, reprieve from one of the most punitive tax rules in recent memory. It's a change that will put real money back into the real economy, potentially stimulate the housing market for individual buyers, and provide a much-needed financial cushion. But the ultimate question looms large. Is this just a temporary political maneuver, a 5-year patch designed to win votes before it disappears? Or is it the beginning of a larger, more permanent re-evaluation of how the federal government taxes its citizens in an increasingly unequal economy? With a firm expiration date already set, the clock is ticking loudly. For now, it's a victory for the taxpayer. But everyone will be watching to see what happens when the clock strikes midnight on the final day of 2029.